This is Nightly Business Report with Bill Griffith and Sue Herrera.
September to remember, August was one to forget as investors figure out their best strategy for the weeks and months ahead. On the front lines, the country's busiest port is even busier just days ahead of the implementation of new tariffs on Chinese imports. And turning your closet into cash. One company is setting out to reinvent the storage industry, connecting people who have extra space with those who have extra stuff. Those stories and much more tonight on Nightly Business Report for Friday, August the 30th. And we bid you a good evening, everybody, and welcome. Sue is off tonight. August is in the books now, and long-term investors are probably just happy to move on. It was the second worst month of the year for the markets. Volatility came roaring back. Trade tensions and recession signals from the bond market headlined the period. And after 4 weeks of big ups and downs, investors today were able to catch their breath a bit as we head into the holiday weekend. The Dow rose 41 points today to close at 26,403. The Nasdaq was down 10. The S&P added just 1. And for the month, all the major averages were lower. So what will September bring? Mike Santoli starts us off tonight from the New York Stock Exchange.
The month of August has lived up to its reputation for volatility, and now comes September, which has similarly tended to be a challenging month for stocks. Over the past 90 years, September has been the weakest month for stock market returns, with the S&P 500 down slightly more than half of all years, and the average return from all years a negative 1%. This certainly implies the seasonal forces present a headwind for a market that has pulled back from its late July peak. But it's important to recognize historical calendar patterns are rarely a decisive factor for market performance. More central for investors are a familiar set of issues: relentless downward pressure on bond yields, growing questions about whether the trade war is snuffing out global growth, and a stock market that has retained most of its gains for the year despite corporate profits riding near the flat line. Set against the cloudy growth and trade outlook, though, bulls will note that equity valuations have now dipped below their 5-year average based on forecast earnings, and historic lows on bond yields make stocks look relatively inexpensive, all else being equal. And investor sentiment has turned quite cautious based on investor surveys, flows out of stock funds, and intense demand for downside protection in recent weeks. Wall Street is getting itself clenched up against growth threats, and confidence has waned in central banks' ability to help. So can the Federal Reserve do anything to ease investor fears and support the expansion with its expected rate cut in a few weeks? Well, that is one of the many urgent questions that lie ahead in September. For Nightly Business Report, I'm Mike Santoli at the New York Stock Exchange.
Let's turn to Luke Lloyd now for a look ahead and how you might want to position your portfolio heading into this new month. He's an investment strategist at Strategic Wealth Partners. Luke, good to see you. Thanks for joining us tonight.
Yeah, thank you. Thanks for having me.
What we saw in August was pretty much a continuation of what we'd seen in previous months, where defensive sectors were the outperformers as Wall Street just sort of rushes to the safety of those sectors, especially the bond market as well. What are your expectations? Do you see that trend continuing into September?
Right. So the whole month of August was a very volatile month, like you said. And there's a couple reasons for that. Trump's been tweeting a lot. Jay Powell had their meeting where he spoke, and the G7 summit. So really, we really expect the volatility to stay because, first of all, there's weak international data right now. And the U.S.-China trade war is still going on. And that being said, we think that's going to stick around as well. And I know U.S. elections are still about a year out, but at the same time, we still think with all that lingering around, there's still going to be volatility in the markets.
So I see you're saying get defensive here, utilities, REITs, those interest-sensitive sectors that have benefited from these record low interest rates. But at some point, when does that become what we would call a crowded trade and not as much safety? What do you think?
Well, I think we're actually pretty close to that. Utilities, REITs, staples, I mean, they're all very expensive from a valuation standpoint. People are trying to chase yield. What we're trying to do is actually position ourselves defensively in other sectors like tech. You know, for example, like we really like software over semis. Software provides recurring revenues, and they provide high margins, so they provide a lot of profit. So in regards to hardware, like semiconductors, they actually provide low margins, and they're all about productivity and producing. And we don't have producing in a recessionary scenario. It can typically provide some type of backdraw, and we really like software over semis.
Right.
So I mean, you have to really get defensive in other individual sectors, maybe other than REITs, staples, and utilities.
The Fed clearly there's a debate going on even among the bank presidents and the governors about whether they should in fact cut rates. You had the former president of the New York Fed with that controversial op-ed piece this week saying they shouldn't cut rates, among others who've said the same thing. What are your expectations from the Fed, and what if they don't cut this time around?
So they actually have a meeting on September 18th, and we're really going to be eyeing that closely. The market right now is pricing 100% probability of at least a quarter of a percent cut in the interest rates. So that being said, we think the Federal Reserve is going to maintain in line with expectations because we really don't think they're going to over deliver or under deliver. So we really think they're going to maintain that posture and deliver what the market expects.
All right. Well, here we go. We'll see what happens. Luke Lloyd with Strategic Wealth Partners. Again, thanks for joining us tonight.
Thanks for having me.
Those new tariffs are set to kick in on Chinese imports this weekend, and Chinese officials are still hoping that the U.S. will call them off. The concern among investors, as you know, is that the trade dispute will intensify further and hurt economies around the world. Eunice Yoon has more from Beijing tonight.
2 days until new tariffs kick in. On Sunday, a little after midnight Eastern Standard Time, the U.S. will impose a 15% tariff on $125 billion of Chinese goods. China will add an extra 5 to 10% tax on its first tranche of $75 billion of U.S. goods, including soybeans. The Foreign Ministry said today it hoped that the U.S. would show its sincerity with real action, which is China's way of urging the U.S. to call off the tariffs. The ministry also said the trade teams have been maintaining effective communication. Meanwhile, the yuan is headed for its worst month since 1994, and there are signs authorities here are getting nervous about capital flight. The Nikkei newspaper is reporting that regulators have put more restrictions on banks for yuan currency conversions and on real estate developers' access to foreign currency bonds. For Nightly Business Report, I'm Eunice Yoon in Beijing.
And many of the items affected by these new tariffs are consumer goods, things like smartwatches, televisions, and shoes. A large portion of those goods come into the U.S. through the Port of Los Angeles. Jane Wells is there at the nation's busiest port to survey the scene.
This really is America's gateway to Asia, and I want to show you what we have going on here at the Port of Los Angeles. This ship came in from China, but this ship is in from Korea, and that ship over there is in from Vietnam. So you're seeing how the supply chain is changing, but we're starting to see another issue here. So many containers are coming in as retailers have tried to front load merchandise for the holidays ahead of the new tariffs that the port's starting to get clogged, like it was a year ago when they were trying to beat the first set of tariffs. Warehouse space in Southern California is now, the vacancy rate's below 2%. They're going to run out of spaces to put everything. But here's why they did that. When the president first announced this new set of tariffs, retailers tried to get everything in here they could before the holidays. Think of those doorbuster TVs for Black Friday. Well, in an 11-day period here this month, Steve Ferreira of Ocean Audit says 260,000 TVs from China got into this port and the Port of Long Beach next door. He called that a surprising surge. And even though the president later delayed the tariffs on TVs until December, well, these ships were already at sea. But the port is also telling us that unless things change, starting Sunday, 98% of the stuff coming in from China is going to be tariffed. We're talking $164 billion worth of goods. And the fastest growing container traffic here right now are empties, because we're still importing stuff from China. The number of containers coming in full and leaving in empty is up 20% in a year. For Nightly Business Report, I'm Jane Wells at the Port of Los Angeles in San Pedro.
A new report this morning pointed to a big dip in consumers' sentiment. The University of Michigan surveyed recorded its biggest monthly drop since 2012. It cited increased uncertainty about the outlook for the economy due to the ongoing trade tensions between the U.S. and China. Time to take a look at some of today's upgrades and downgrades. We begin with shares of Ulta. They were downgraded by a number of firms today, including Wells Fargo, which cut its rating on the stock to market perform from outperform. The analyst cited the highly competitive cosmetics industry right now and slowing trends. Remember, last night, Ulta reported disappointing earnings and lowered guidance for the rest of the year. Wells Fargo's new price target is $235, but that stock today lost 30% of its value, now to $237.73. Abercrombie & Fitch was upgraded to hold from sell at Deutsche Bank. The analyst says that the company's declining margins are now reflected in its guidance, and that price target is now $14. The stock rose 1% today to $14.62. Still ahead, why Netflix, the streaming powerhouse, is debuting some of its original movies in theaters first. Hurricane Dorian continues to strengthen as it heads toward Florida. It is expected to make landfall late Monday or early Tuesday, and if it stays on its current course, it could potentially be the strongest hurricane to strike Florida's east coast since Andrew back in 1992. Analysts say that the damage to crops in the region could be significant, specifically citrus, sugarcane, and peanut production. Earlier this week, we told you about a proposal that Purdue Pharma was pursuing to settle opioid claims. Well, today, the Wall Street Journal said that it's getting a mixed reaction from various states. Some attorneys general say that the cash portion of that offer is not high enough. The Sackler family, which owns Purdue Pharma, has offered between $10 and $12 billion over a number of years. Separately, Allergan confirmed today it is planning to pay $5 million to get out of an upcoming federal opioid trial in October. That settlement is between that drug maker and 2 Ohio counties. More than a dozen other companies, though, do remain as defendants in that case. United Airlines said today it plans to resume flying its 737 MAX planes just in time for the busy holiday travel rush. The airline's new date to bring that plane back in is now December 19th, provided that the FAA says the MAX has been fixed and is safe to fly. Phil LeBeau has details.
United's move pushing back the return of the 737 MAX gives the airline a little more breathing room to schedule flights for the beleaguered plane. For weeks, the airline maintained it would fly the MAX by early November. Now it's moved the return date back to December 19th, shortly before when Southwest plans to fly the MAX, while American still targets early November. Boeing says it's making progress validating and tweaking software upgrades for the flight control system of the MAX. That system is a primary factor in the crashes of 2 MAX planes that killed 346 people. In March, the FAA and other regulators around the world grounded the MAX. Now, a panel of those regulators says it expects to issue its report on the 737 MAX in the coming weeks. The new head of the FAA, Stephen Dixon, says he won't let the grounding be lifted until he's convinced the plane is safe to fly again. Boeing CEO Dennis Muhlenberg says that could happen as soon as October. If the MAX is back before the busy holiday rush, it will be welcome news for United and other airlines that need more planes in order to meet the strong demand of people flying. But how many of those travelers will balk at getting back on a 737 MAX again? That could make the return of this plane a bumpy one, regardless of when it happens. Phil LeBeau, Nightly Business Report, Chicago.
Campbell Soup heats up in their sales, that is. That's where we begin tonight's market focus, with the company reporting better than expected earnings thanks to stronger demand for its soup and snack brands like Goldfish and Kettle potato chips. Campbell has been selling non-core brands recently so that it can focus on soup and snacks, and it seems to be working. That stock nearly jumped 4% today to $45 even. Big Lots reported better than expected second quarter profits, making it the latest discount retailer to post a solid quarter. The company also said it should be able to withstand any tariff-related headwinds that come its way. The stock was up more than 3% to $22.75. China's government announced that it's going to exempt Tesla models from that country's purchase tax. The exemption could reduce the cost of the car. No reason was given for the decision, by the way. Tesla has invested heavily in China, which is the world's largest automobile market. Shares were up nearly 2% today to $225.61. Activist investor Jana Partners has taken a nearly 10% stake in Bloomin' Brands. In its SEC filing, Jana called the casual dining restaurant shares undervalued. Jana intends to discuss a possible sale, divestiture, and board composition with management. Bloomin' Brands shares rose more than 7% today to $18.04. And Comcast is reportedly dropping Lionsgate's premium channel Stars from its bundle at the end of the year. The decision was first reported by The Information. The deal currently is in place, and it's set to expire in 4 months. Lionsgate declined almost 5% today to $9.03. Comcast was up a fraction to $44.26. And we must mention that Comcast, as you know, is the parent company of CNBC, which produces this program. So the summer box office was not quite as hot this year as it has been in the past, but analysts say that business could heat up this fall, even as the weather cools down. Julia Borston is in Los Angeles.
Despite a few mega hits this summer, like Lion King, Avengers Endgame, and Toy Story 4, overall it's been a disappointing summer season. The year-to-date box office is down 6.5% from last year, putting 3 key themes in focus this fall. First, Disney's expected to continue to dominate after drawing over 36% of domestic ticket sales this year, with 5 of the top 6 movies, including Avengers Endgame and Lion King. Coming up, Disney's Frozen 2, Maleficent, Mistress of Evil, and Star Wars, The Rise of Skywalker are expected to build on their franchise's success.
Disney is really adept at taking all their brands, looking at the best parts of those brands, reimagining, rebooting, creating franchises, and bringing in tons of audiences around the world.
Hi, Frank. This is Jimmy Hoffa.
Second, this fall, Netflix will put 10 of its movies in theaters, including Martin Scorsese's The Irishman and The King, starring Timothée Chalamet. This is Netflix's biggest push into theaters yet, putting these films on the big screen for less than a month before they're available for streaming, and they'll be only in limited release after Netflix failed to strike deals with the big theater chains. Netflix's theatrical strategy isn't about selling tickets, but about chasing Oscars for its big-name filmmakers and for promoting the exclusive content it streams after U.S. subscriber numbers declined last quarter. And with films such as Ford vs. Ferrari zooming into theaters, the third theme to watch, the performance of non-franchise films, as studios such as Fox's new parent Disney consider the value of investing in this kind of standalone film.
Successful non-franchise films are hard to find because audiences are seemingly gravitating towards the tried and true brands, the franchises, the reboots, the things they know and love, and steering clear most of the time from original content.
While Sony's Little Women and a Mr. Rogers biopic starring Tom Hanks will be a test of demand for this kind of Oscar bait. With Disney and Universal together controlling over half the box office, we'll see how the smaller studios hold up and whether they could get snapped up. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Time now for our weekly market monitor, who has 3 names in the financial services industry that he likes because they have pricing power. This is his first time on our program. We welcome Dev Katasaria. He's founder and portfolio manager at Valley Forge Capital Management. Dev, thanks for joining us tonight. Welcome.
Thanks for having me.
And we start with Fair Isaac, the famous ticker symbol FICO. Of course, they do credit reports and things. I was looking at a 5-year chart of this. $50 5 years ago, $350 today. You think there's still more growth to go, I guess?
We do. The company has a virtual monopoly on consumer credit scores, mortgages, auto loans, credit cards. And, over the last couple of years, they've instituted special price increases. Last year, it was mortgages. This year, it's auto loans, and they'll roll that out to other areas in the future. And they've also instituted general price increases every year above the rate of inflation. They still represent a very small portion of the overall credit decision amount. And so we think there's plenty of room to grow on pricing for this company.
And then the second one is Moody's. A lot of these charts look similar as it happens. It's had a great growth rate over the last several years as well. Why do you like Moody's?
Moody's is in a natural duopoly with S&P Global.
Right.
They rate 90% of all the debt in the world, and you could think of them as toll collectors. When someone needs to issue debt, you have to go through Moody's and S&P. They collect a small piece of that transaction. There's a lot of debt that's going to be issued and refinanced over the next 10 years. And so they have tremendous pricing power. They've increased their prices annually above the rate of inflation for many years, yet still represent a very small portion of the overall debt issuance costs. So we think it's going to have a very bright future.
You like these companies that are in duopolies. So here's another example. Visa you like, but its main competitor would be MasterCard, I guess. Do you like Visa instead of MasterCard, or do you like them both necessarily?
We like them both, and we own them both. They control virtually every payment transaction in the world. They take a small piece of every credit and debit card transaction. And given the trend towards electronic payments, they've had robust growth in the past. We think that can continue into the foreseeable future. Despite disruptive technologies, Visa remains at the top of the food chain. And we think as long as there aren't government controls, pricing controls on debit and credit card transactions, Visa has a very long path of strong organic growth going forward.
Dev Kantasaria with Valley Forge Capital Management. Again, thanks for joining us tonight.
Thank you for having me.
And coming up, one person's clutter is another person's opportunity.
Is this someone's attic or a cash cow? I'll explain coming up on Nightly Business Report.
Got stuff? Everybody does. It piles up in our homes and takes up space. And now a new company thinks it has a solution. It's taking on extra clutter and matching it with extra space. Diana Olick has the story from Atlanta tonight.
They say in every attic there is hidden treasure, but now there is hidden profit, and not just in the attic. Anywhere you have extra space in and around your home. Thanks to the shared economy and a new company, Neighbor, people who have extra space are connecting online with people who have extra stuff. So you can store your stuff in someone else's house instead of renting a pricier storage unit. Barely 2 years old, Neighbor, which charges users a fee, has seen 500% annual growth, according to its CEO. It's now available in 48 states and is going international.
It's not just garages and basements and driveways. We'll have people put up barns, their old barn, and they'll store classic cars in their barn. We have people put up even small spaces. In university towns, we'll have people put up a closet, and students will come store 2 or 3 boxes in their closet.
Exactly what the Cohen family is doing in their Atlanta home. They rented out a corner of their attic to a college student, and she brought her extra stuff. They're also going to rent their extra parking space.
We're not looking to rent out an RV with somebody Airbnb-ing their RV or living in it.
There's a limit.
There's a limit. We draw the line. I draw the line.
Homeowners are allowed to inspect anything they store, and Neighbor insures them for up to $2 million if the stuff should somehow hurt the house. And homeowners can reject anything.
We definitely wouldn't have like fireworks or anything
Weapons,
like that, chemicals.
Explosives, or animals, or humans.
And for those renting the space, it's a lot cheaper than the big public companies because homeowners have less overhead.
We also looked around at like what U-Haul or one of the bigger self-storage places are charging, and then went below that, but wanted to keep it somewhat comparable.
There are 6 self-storage REITs, and the sector is very strong. But you have to wonder, is this going to do to self-storage what Airbnb did to hospitality?
Currently, there are more storage facilities in the United States than there are Starbucks, McDonald's, Walmart's, Home Depot's, Domino's Pizzas, Dunkin' Donuts, and Costco's combined. So it's just this massive, massive industry that we're trying to disrupt.
And so far, it seems there is plenty of space for this disruptor in the space. For Nightly Business Report, I'm Diana Olick in Atlanta.
Finally tonight, the business of tennis. The $6 billion industry is preparing for a tariff hit this week, and tennis balls are subject to increased tariffs on Sunday. Tennis racket tariffs will be increased in December. But with the U.S. Open underway in New York, the focus right now is on the sport itself, and some amateur players are finding high-tech ways to improve their game. Here's Eric Chemi.
These Division I tennis players spend a lot of time practicing at this typical-looking tennis court in New Jersey. But high-tech video and data analysis is changing the way future pros are learning the game.
You can't really see all the little details that with a human eye than you can with a camera or on technology. So small details really show up.
You can slow it down and like really see where you're making mistakes or losing power.
The Court Sense teaching program is owned by one of Novak Djokovic's coaches and features the PlaySight camera system based on Israeli Air Force technology.
When you made that correction, all of a sudden now your ball is 5 miles an hour faster or slower or more spin.
The technology made an immediate difference for me, showing exactly what I was doing wrong, like dropping my left arm rather than keeping it up to stabilize the ball. It goes beyond tennis, too, with sports biomechanics looking for any flaws or asymmetries in the player's mental reaction time and physical performance.
If you're a better athlete, the science behind athleticism says that you'll have reduced injuries and a longer career.
I feel that every generation gets better, partially because of technology gets better.
For Nightly Business Report, I'm Eric Chemi in Tenafly, New Jersey.
And before we go, a final look at the day on Wall Street as we close out August. The Dow rose just 41 points. NASDAQ was down about 10. The S&P up less than 2. And for the month, all the major averages were lower. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching. Have a great long weekend. We'll be back here Monday for a special edition of NBR. See you then.